Seller financing is one of the most important deal terms in an M&A transaction. So whether you're buying or selling a business, you really need to have a good grasp of this topic. In this video, I'm going to break down what seller financing is, how you can use it to your advantage as both a buyer and a seller, and then common misconceptions and other things that can kill a deal if you use seller financing in the wrong way. So to start with a few definitions, seller financing, you can really think about it as an IOU from the buyer to the seller. Basically, it's saying, I'm going to give you X amount of the purchase price today, and then over the next period of time, I will make either monthly, annual, semi annual payments to pay off that loan to you. And that will come with an interest rate. So it's really just another form of financing the deal. So typically, a buyer is going to bring some amount of cash. So if you're thinking about it like buying a house, you have the down payment, then you have the mortgage from the bank. And what's a little bit different in businesses is often that last little bit of the transaction is going to be seller finance. So they're going to act as another bank effectively for the buyer. Now, if you didn't watch my other video, I did a coverage on other deal terms like earnouts, but we're just going to talk about seller financing today. But I will link the earnout video below if you want to learn about other deal structuring tools as well. So we have our seller financing. Now, you might be asking, how much is normal in a transaction for seller financing? And it really does range and vary. If you have a business that can't be financed very easily by banks, sometimes the seller financing can be a significant portion of the purchase price, in excess of 50%. But I would say that's really rare. In general, you're going to see anywhere between 10 to 30% of the deal as seller financing. The magic number is generally around 10% of a particular transaction, as that's what the SBA and Canadian banks will often use and credit as equity in a deal. So if the loan is secondary to the bank financing, so that seller financing loan from the seller to the buyer, if it is secondary to the loan, so meaning it gets paid after the bank financing gets paid, or on terms that are agreeable to the bank, you as a buyer can actually leverage seller financing as a part of your equity down payment. So you actually need to put less capital into the deal. Which can be a great advantage if you were to look at any really strong private equity group or professional buyers. They're trying to put as little cash into any particular deal because it makes your returns better. It's the whole concept of leverage. So if you can actually get away with getting a bit more seller financing, it makes your returns a lot better. The problem is that a lot of sellers are, one, nervous about seller financing because there is a risk that you fail running the business as a buyer and they walk away with nothing. The other thing is that they have to wait sometimes a long time to get paid. So you have to be able to reward them with a interest rate that makes it worth their while. So you may be wondering, what is an appropriate interest rate on a given seller financing deal? It very much ranges based on the macroeconomic conditions of the economy. So when interest rates are low, seller financing is a bit low. When interest rates are high, seller financing is relatively higher. So we've seen it as low as 5-6%, all the way up to in excess of 10%. Again, depending on where interest rates are. And generally, again, if it's in the mix with other bank financing, sometimes it has to be interest-only payments. Sometimes it can be blended into a principal and interest payment. And the terms of these things, so you may be wondering, generally it can be as short as a 12-month period if, again, you are not maybe relying on external bank financing. You're doing most of the deal as seller finance. Sometimes it can be very short, just as a way to use cash flow to pay off the seller as a buyer, all the way up to 36 months, 5 to 5 years, or sometimes even longer. But again, that's rare. I'd say the more average that we see is anywhere between 24 to 48 months on average, sometimes longer, again, depending on what the banks require. Now, how secure are these things for you as a seller? That's going to be the big question. What's your collateral if a buyer just says, hey, I'm not going to pay for it? So this is best answered with your lawyer, which is why you need to have a strong M&A lawyer on any given transaction. But generally, there's going to be some amount of security that is required from the buyer in exchange for this loan. So whether that is personal assets or a personal guarantee on the seller note, so that if the buyer defaults, you have some sort of recourse to claim some assets. Now, no buyer really loves that, and that's always a difficult path to go. Sometimes there may be business assets that are pledged as a part of the collateral that you can take back. Again, these things are a little bit harder to achieve in reality. So if the buyer does run your business into the ground, it may be hard to reclaim much value after the fact. So there is some risk. That being said, generally, historically, there's a very high success rate in terms of business financing for transactions. And in Canada, there's a very, very small default rate on business acquisition loans, which generally almost all include some seller financing. So it's more likely than not, they tend to work out, but you do need to talk to your lawyer to think about the worst case scenario and what would happen if payments were not to happen. And again, that is something that you're going to discuss with your lawyers and M&A advisor to structure and make sure you're comfortable with. So that's the quick summary of seller financing. It's an incredible tool to use in a transaction if you use it right, and can be really important for bridging financing gaps between a buyer and seller and the bank financing that's available on a given deal. So do use it wisely.